Hello, everyone, and welcome to my YouTube channel. It is a great pleasure to have my good friend, Tracy Shuchart, who's the founder, CEO, and Chief Market Strategist for Hilltower Resource Advisors. A must-follow account. You'll get all the details in the details below on the video, how to follow her. How are you, Tracy?
I'm great. Glad to be back. See you again.
Exactly. It's been a long time, but it's always good to catch up. And I would like, if it's okay, for you to start with an overall view about how you see the commodity complex, what is going on right now. There's a tremendous amount of news flow coming, both from the geopolitical side, the supply side, etc. And many of our viewers are a little bit puzzled about what is really driving markets. So if you would start by, giving us a little bit about your idea of how what is happening, and I will take it from there.
Well, I guess we could start with the energy complex. If we're going to start with obviously the recent events that are going on in the Red Sea with the Houthis. There was 4 new attacks this week. We've seen container ships halt their transit through the Red Sea. They're going around the Cape now. Now, initially, we didn't see oil tankers do this because they largely had been leaving them alone. But we are now we've had a couple attacks on tankers, and so on British tankers to be exact. And so we are now seeing those tankers move around the Cape as well. And so I think that is now just starting to reflecting in oil prices. Yeah. Everybody was kind of wondering, why aren't oil prices moving with all these dangers in the Red Sea? And it's really because largely they were left alone and there was no difference to their transit. And so particularly Europe is going to be hit hard by this. And we're already starting to see that, as far as the container ship world, we're starting to see, we've seen some big retailers already say they are expecting delays in Europe. And I think, this is obviously going to cause problems in the energy complex as well in Europe first. Because we also have problems in the Panama Canal that have been ongoing as far as the water levels are too low to really transit a lot of ships at the same time. And so now we have 2 big choke points that are in trouble right now. And so I think we definitely will start seeing that in the energy complex, particularly with diesel products. And we're already seeing those gas oil cracks blow out in Europe right now, those European gas oil cracks. And so I think we're going to definitely have, we're already seeing stress in the diesel market. But I think this will continue and help keep crude oil prices elevated as well. The other thing that I'm concerned about is that because of these supply chain disruptions, I don't think that central banks are really prepared for a spike in inflation and problems again. And so I think if we do, and we are starting to see a little bit of an uptick in CPI and PPI that we just had in the United States. But what people don't really understand is that what's been happening over, since December with these attacks hasn't really affected anything. Those shipments haven't even arrived to the US or are just arriving to the US, right? And so they think that they got this inflation beat, and I think this is going to be a problem. And of course, I think if we see an uptick in inflation, that'll also start affecting precious metals markets.
When you look at the commodity complex and the lag effect that you just mentioned, which I think is very, very important for inflation. Right now, a lot of people are calling basically the idea that there's not going to be any problem for inflation because the supply chain disruptions in the Red Sea have not manifested yet. in CPI. But you very well said, it's going to take a few months actually to show itself fully in CPI. In the euro area, that is pretty evident. A lot of people actually, prior to our discussion, were saying, well, I don't understand why gasoline prices are going through the roof here in the euro area when oil prices are not that high. Well, you just mentioned it, not massively higher refining margin and diesel shortages. So what type of lag do you think we're going to see before that fully manifests in CPI? Because that also has an important driver for interest rates, no?
Yeah, I don't think we're going to see this until summer, to be honest with you, in the United States particularly. So I think it's going to take a few months. And, and what's funny is this is exactly when, the market is pricing in rate cuts. For the Fed, right? First we were in March, and then we had the hot CPI and PPI numbers, and then that kind of moved out to July. But, that's really when we're going to start seeing these supply chain effects. And so markets might be disappointed with the Fed's decision at that point if we, start seeing spike in inflation again.
Oh, certainly. And it's interesting because on the one hand, the inflationary pressures have not come down significantly on the core side. Then everything that has been the positive surprise on inflation came from the energy side. So we have this lag effect on oil. But what about natural gas? Everybody's quite puzzled about natural gas these days. It's been significantly weaker than what many expected. Obviously, a warm winter, huh? But what is your overall take on what can we expect out of natural gas prices?
Well, I think, right, it wouldn't surprise me if we kind of skid along this lower level much longer than people think. We're very well supplied in the United States. Then we had Biden's decision to halt export licenses, which obviously didn't help the market because, or sentiment in the market, obviously, because that means we can't export what we have, and we definitely have enough. And so I think that really, because, we don't really have any supply chain issues right now, Europe, for the most part, really has acclimated itself to the change over from, Russian piped gas to importing LNG. They're starting to make some long-term contracts, which they weren't really doing, in 2022 and the beginning of 2023. And so I think that bodes well for at least the European markets right now. Now, that's not to say we can't have, some unmitigated disaster somewhere. We never know what's going to come up, right? But I think right now, particularly in the United States, I would say low prices help low prices, right? So, and we've already seen, we had like Antero Resources, Comstock, and Equitrans had earnings last week, and they all came out and said, we're curbing natural gas production because it's not profitable right now at these levels. And so I think, again, the cure for low prices is low prices, but that's going to take time to filter in the market and for the market to really see if these companies do kind of scale back on production.
Mm-hmm. It is pretty evident that the supply side is ample in the United States. In the European Union, things look very optimistic from the politician side, because LNG prices have not spiked, But the LNG market is certainly very tight, and obviously we've had an external support, which is China. China has not grown as fast as people initially expected, but China doesn't slow down forever. So how do you see the LNG market? You mentioned an important factor, the delay in the approval of these LNG terminals in the United States. China seems to be recovering from a slower, at least a certainly slower level of demand growth in commodities. How do you see that picture moving for our viewers?
Well, I think that China definitely will start picking up. When that is, probably we're not going to see that until the back half of this year, because I think it's going to be a very slow ramp up. And certainly, that's going to help, obviously, industrial metals, base metals, and things like that. If we see an uptick in their manufacturing, and if they kind of get a hold on their property sector, right? We just saw them lower mortgage rates. They're trying to spur that property sector again. So if we start seeing increase in building, that certainly will help the commodity markets in general. But I think, again, that's just going to take a little bit longer than most people think. I think people were thinking as soon as China reopened, there was going to be this big boom, and that just never manifested itself. But I think that China's not going to, China. They're not going to let this last too long. We really haven't seen a ton of stimulus from them, not as much as they possibly could. But I think now, looking at their stock market and looking at the deflationary pressures that are going on, I think we're going to see them get more actively involved in the market.
Mm-hmm. One of the things that you have shown a few times in your Twitter account is that while all these things that we're talking about at the beginning of this conversation are fundamentally about supply and a little bit about demand, we have on the other side of the background a very challenging environment for investment. We have central banks limiting the way in which we finance access to energy, and even forbidding, in some cases, the financing of fossil fuel investment. What is in general your view about the investment world in terms of capital expenditure and what is required in order to maintain a healthy supply?
Well, obviously that it's lagging, particularly with fossil fuels, right? And so, we're still going to need, out to, 2030, we still need $14 trillion of investment just in oil and gas, just to kind of keep us where we are.
Yeah.
And so I think this sets us up for, again, higher for longer in the oil markets. I mean, people forget, people say, we're at $77-80 for WTI and Brent, and that's historically still very high, even though everybody's expecting this to be over $100. But in reality, oil over $100 is not good for any economy, right? It's not good for emerging markets. It's not good for anything. It slows growth. And so, you don't really want to see sustained oil prices over 100 if you want to keep the global economy moving. So, I think this is kind of a comfortable range to be in right now, even though we're kind of in a wide range, that like we're in that kind of like 70 to 90 area. We've kind of been bouncing around. So it's a wide area, but it's been relatively stable and relatively quiet for quite a few months. And I don't think that's necessarily a bad thing for the energy markets.
Oh, I completely agree with you. I've had I don't know, the pleasure, or certainly the honor of going to 5 OPEC meetings in my life. And OPEC members always talk about stable oil prices as the key element to keep suppliers and customers certainly relatively well, and to avoid a financial crisis or a demand crisis. $14 trillion means that, if I'm not mistaken, we are basically running about 30% below the level of capital expenditure that would be required to reach that level in the past couple of years. Am I not wrong?
Oh, no, absolutely. I mean, no oil companies want to spend money really in this industry, particularly if we look at the United States. We're seeing all these big mergers and acquisitions, right? Because instead of what we're seeing is, companies are buying capacity rather than creating new capacity, right? And so, and I think the mergers and acquisitions are probably certainly not over, and we'll probably see more in the oil patch and definitely more in natural gas, because companies just don't want to spend the money and they want to keep investors happy right now. No investor wants to see capital expenditures. All they want to see stock buybacks, they want to see dividends, and they want to see debt paid down. That's all they care about right now.
Mm-hmm. What is your take on the changes in policy? We have seen, for example, in the European Union, finally they seem to have realized that without nuclear, you cannot have any type of decarbonization. It seems that the view about natural gas has also changed. Policy globally, how do you see the environment? It seems, am I right, that politicians are starting to improve a little bit their view from a very ideological perspective to a more benign?
Well, I think that, that energy spike in 2022 after the invasion of Ukraine certainly scared some politicians. And I think, they're waking up to, we've had a lot of unrest. You've had a lot of farmers protests and things of that nature. You've had, some elections that have spurred more, progressive candidates, right-wing candidates that kind of, I think, are scaring kind of, particularly the European Union. And so I think that, you just have to get more realistic in your goals. And, natural gas is very clean, contrary to popular belief, definitely compared to oil or coal. And, again, I'm still surprised at Germany's reluctance to, turn back on their nuclear, and they keep shunning nuclear, which is wild beyond imagination. And I was actually talking to a nuclear engineer and said that really, if Germany wanted to turn their nuclear plants back on, they could do it within 9 months. That's pretty quick. And so it's just shocking that country is still holding back on nuclear. But, going forward, we're seeing a lot of activity in nuclear in particularly Asia.
Yeah.
Right. We're seeing Japan is turning back on 12 new plants, plus extended the life of a few more. Obviously, we're seeing China build out. We're seeing South Korea build out. And so we are definitely seeing a lot of activity in Asia.
Yeah, completely. I think that the problem in the European Union energy policy is that what we're seeing is that on the one hand, the French are very pro-nuclear and they continue to be, and it's shaping back policy for investing in some new reactors. But Germany is not going to return its nuclear production back. And I find it amazing, to be fairly honest, Tracy. When I look at your Twitter feed and you put all the data about the German economy, I find it amazing how the country has spent more than $500 billion in subsidies for solar and destroyed the nuclear fleet, and now relies more on coal than 20 years ago. It's pretty phenomenal. But that, unfortunately, that ship has sailed.
And this is hurting the German economy. I mean, we're seeing companies move to the US, we're seeing companies move to China because energy prices are lower. There's a lot of subsidies and tax breaks that the United States is giving to German companies, in particular in the automotive industry, because of the IRA Act. And so it's a very enticing place to go do business, plus cheaper energy prices, obviously. And so it's amazing to me that the manufacturing powerhouse that was Germany is kind of letting that industry get away from them.
Oh, it is a surprise. I think it is a surprise for everybody because it seems like the country has decided, once realized that the energy policy was incorrect, instead of changing or altering the mistake and trying to revert it, decided to double down, no? And it's certainly hurting the exporting industry, the manufacturing industry, as you very well said. And at the same time, it's also delaying massively the decarbonization plans because, funnily enough, what ends up happening is that these people end up consuming more coal, and the entire decarbonization plans of the European Union are crumbling down due to higher consumption of coal. And you said something that I think is very important, which is you cannot have a decarbonization process without natural gas. Natural gas is a very important element to help in the energy transition. Of course, nuclear as well. But without natural gas, there is no decarbonization, is it?
No, I absolutely agree. And particularly for emerging markets,
Yeah.
right? Because that are heavily reliant on coal, a natural transition is natural gas, and it's cheap. And not as cheap as coal, but it's still, it's relatively cheap comparatively speaking, and certainly cheaper than, solar panels or wind turbines, which can't be used as a baseload power source anyway. And so, it's going to become more and more important, I think, as we move, beyond the 2020s and into the 2030s and the 2040s.
Yeah, but certainly for India, it's the only way ahead to transition from coal to natural gas, and then add nuclear and other technologies to the mix. But it's impossible to go straight from coal to wind and solar because they're intermittent and volatile, and it would be phenomenally expensive and destroy the economic growth and the industrial fabric of the country. Um, which is something that I think is important also because we're in an election process in the United States now. How do you think that energy and energy policy is going to shape the debate in the elections in the United States?
Well, I think we're already seeing, the two sides of that right now. It's already starting out. So, you have the current administration, which is, trying to appease the younger voter environmentalists. That was kind of behind the decision of pausing export licenses because they were very unhappy that they allowed the Willow project in Alaska to go forward. And so now, nearing the election, we're seeing a lot more decisions kind of geared towards environmental, ways kind of just to appease the voter base, to be honest with you. And then, of course, you have on the other side, you have, Trump, I guess he's the only other viable candidate at this point, is all about expanding, the energy world. And, we're seeing this divide, it's a huge divide between states in the United States too, between red and blue states. And so it's a very divisive issue really within the United States right now. And it's really hard because, the US energy industry is, we're an exporter now,
Yeah.
right? And, we export more than we import at this point. So we're a net exporter, even though we're not energy independent. I don't want to confuse those two, but we're a net exporter at this point, and that brings a lot of money and jobs into in the country. And so I think this will be a big center of the debate. And I think as we get closer to the election, I think this is going to become a bigger and bigger role, because we also have this same divisiveness in Congress as well, where you have, pro energy and, pro not energy. And so, again, I think that this will become increasingly more important.
I think that one thing that I find interesting is that in the Euro area, in Japan, in the UK, the the perception about energy coming from the young voter side, and certainly from the people that have a more logical view about energy transition, etc., has changed significantly. I have seen that the level of divisiveness relative to one technology versus another has changed, not a lot, but quite significantly, at least to the extent that, for example, in the UK, Labour and in the Euro area, in Italy and in Spain, certainly in Portugal, most of the sort of more progressive side of the spectrum are becoming less aggressive about what type of technologies to defend relative to security of supply and competitiveness. For what you're saying, you don't see that kind of sort of softening of the debate over there, no? Rather the opposite, it seems.
I think it depends. Well, I think Europe is a little bit different because energy prices still have remained relatively high. I mean, they've come down, but they're still relatively high. And I think, people are now starting to realize, well, this affects my life, and this affects, the food prices, it affects my electricity prices, it affects, my quality of life. And I think, so I think that's, we're seeing a bit of a softening there. I mean, I think globally we're seeing a bit of softening. I mean, right? We just saw, was it Morgan Stanley Asset Management and State Street just left the ESG Alliance. We're seeing the insurance ESG Alliance basically fell apart for the insurance companies. And so I think even within companies, we're starting to see a little bit of difference. But, I think in the United States, because, food prices are high here, things of that nature, I think we just haven't really been that affected. So I think we still kind of have this divisiveness here, but it is softening, I think, in general, not just with the populace, but, we're seeing this with companies as well.
I think that in companies, it's very evident, certainly. I completely agree with you. And in the environment of the energy world, how do you see the what I always call the hidden elements of energy that nobody seems to be discussing too much, which is the shortage of copper, the shortage of lithium, the challenge to access rare earths. In order to achieve the targets that so many of the governments have for implementation and percentage of the overall energy mix of wind and solar, it seems that very few people are talking about how much mining and how much we need to do in order to get the level of basic minerals and that are required for it, no?
Yeah, absolutely. I mean, we've seen the same problem in CAPEX in the mining industry that we've seen in the oil and gas industry. And so they're suffering the same issue there. And, to reach these goals, certainly we're going to need a lot more than we're currently producing, particularly when it comes to something like copper, say. We're going to need more copper than we've ever dug out of the ground ever in history, total, to get to these goals. And so, and then you have the problem that nobody wants it in their backyard. I mean, we've had certainly problems trying to get permitting here in the United States for copper, and there've been lawsuits against anybody trying to mine for these minerals. Permitting takes forever. Same problem in the EU. And nobody wants it here. We also have a problem that most of this processing, particularly for rare earths that aren't really that rare, are all in China.
Yeah.
And everybody's trying to move their supply chains away from China, but literally, they process 90% of all of these critical minerals that we need. So therein becomes another problem, because if you want to get away from China, then you need processing plants outside of China.
Mm-hmm. This problem with, because you just said something that I think is very important. A lot of people think that rare earths are in very limited supply and very difficult to access, but they're not that rare, and it's simply a question of developing and actually accessing those resources. And the U.S. has a tremendous certainly access to those rare earths. You see that there is a significant challenge to develop them, or that is likely to be an opportunity going forward?
I think that it's definitely an opportunity going forth. I think what the problem is in the United States is all the bureaucratic red tape.
Yeah.
And certainly all of the lawsuits that subsequent lawsuits, we love suing people here. So we have the bureaucratic red tape. Literally, it takes almost 10 years to get permitting. We need to streamline that. We need to get those times down if these are the goals that we really want to reach. But certainly there is opportunity here. And then again, the problem is you have environmental groups suing over this, that, and the other. And then you have, the mining companies suing back. And so, therein lies the problem. But there's, I think there's definitely opportunities here, particularly with the uranium market. We've got some junior miners that are already permitted, that are already processing now that uranium prices are high enough for them to actually make money. Before, they kind of were just sitting on their permits. They couldn't really do anything because it wasn't really economical for them to do so. And so now we are seeing some projects in the United States start up with some of these junior miners. And so I think that's a really good area to focus on if we're looking at North American projects. Canada certainly has some interesting projects in Saskatchewan as far as uranium is concerned. And so I think we're, starting to see a positive side to the industry. But again, I think the government really needs to streamline how they move along with their processes, because it does take an exorbitant amount of time to get anything done through the government, which is not unique to the United States.
Oh, no, not at all. I mean, if we look at it from this side of the pond, in the UK or in the Euro or in the European Union, the United States is a blessing compared to what it takes to develop anything. As we always say, the problem is not resources. The problem is having the opportunity to invest and access those resources. Which brings us to the metals world, no? What is your general view about precious metals and base metals? What is your outlook in general? What can we expect?
For precious metals, well, I think if we start seeing a spike in inflation again, I think that will bode well for the gold market. And if we start cutting rates, I think that'll bode well for the gold market. I mean, it's holding above, 2,000 for the first time in a very long time. And I think that certainly geopolitical issues help that as well. I don't really have any gold targets. I think it's great to, own some physical gold just in case. You never know what can happen. But I think I'm really particularly interested in, if we're talking about, energy transition, I'm really interested in silver and platinum.
Yeah.
Because of their industrial uses as well. I mean, you need, if you look at, you need silver to solder everything in an in a vehicle, as far as electrical components are concerned. Now, when you look at an electric vehicle, that's 15 times the amount of electrical components. So that's a lot of silver, particularly if you want to, achieve this goal of, 50% or whatever, by 2035. On the market, we're going to need a lot of silver, and not to mention the amount of silver that's used in solar panels and in wind turbines as well. Also, platinum, in all three, used in all three. We're actually seeing platinum automobile companies actually starting to retool for platinum for catalytic converters in the US because palladium prices had gotten too high. And that obviously takes time and money to retool. And since they started this months ago, palladium prices have come down. Actually, platinum is trading at trading over the price of palladium right now, but those companies aren't going to spend, another $1 billion and so, 9 months to change their tooling back to palladium. So that's also a very interesting market to me as well.
I find it interesting also to see the huge discrepancy between gold prices and gold mining. It seems that this is a trend that we're seeing since the beginning of the process of the central banks talking about rate cuts or no rate cuts, or this controversy about whether that will happen or not. But it seems that there is a wide difference in the stock market between miners and the commodity that they mine. Do you think that is likely to persist, or do you think that I'm missing something in that context?
It's really hard when you talk about the gold market, particularly gold price. It's not just the spot market or the futures markets. The problem is we have all these derivative markets, all these ETFs that are, trading paper gold. They're not backed by anything. So, if you're going to trade it, gold ETF, my advice is find one that's actually backed by gold.
Absolutely.
But so as a side note, so we, because the derivative market in this particular product is so huge, I think that also lends itself to depressing prices a bit, in my opinion.
Yeah, certainly. And the higher the number of these financial products that are added, what you see is obviously that there is a big discrepancy between the physical market and the paper market that prolongs over time.
Yeah.
An important driver of commodity prices in the past years has been central banks and the rate hikes. I always say that in many cases, the rate hikes helped the investors look at the commodity spectrum from a completely different perspective rather than just demand and supply, because with rate hikes and money supply contraction, commodities started to decline despite a rather strong supply-demand scenario. No? You mentioned at the beginning, in the first question, the likelihood of rate cuts as more on the backside of 2024. However, commodities are already starting to behave better, especially oil, in 2024, despite that environment. So do you think that we may have seen the entirety of the monetary impact on commodities, and that now we need to think more of the fundamentals and the catalysts to drive them?
Yes, because I think, I've always said that the rate hikes were actually inflationary commodities because the industry relies so heavily on financing, right? Especially if you're a commodity, physical commodity buyer.
Yeah.
Right. These big companies, they depend on a lot of financing to buy and store commodities. And so the more expensive it is for that, the more, the cost of storage, it just gets to be too high. And so, you need to sell it on the market quickly. And so that adds to, kind of actually hikes add to inflationary pressures, believe it or not.
That's a good
Um,
point. Yeah.
eh,
Yeah. Go ahead.
so I think that we are seeing the effects. I think that sort of, has come out of the market more so. And I think that, the fundamentals will become, more and more in play, because I think, even if we don't see cuts, I don't think we're going to see more hikes. So even that would be better.
Absolutely. Certainly, I don't think that we will see hikes. And even if the energy component of CPI goes up significantly, I don't think we will see rate hikes. The economy would not be able to support it with all the problems in the real estate sector, in the commercial real estate sector, etc. Um,
Exactly.
so just before we finalize, to give us a little bit of an overview about what would be your recommendations for investors in the next few months, so that we can follow what would be the things that you would think as the key ones for the next couple of months, please.
Yeah, I think the uranium market is going to continue to do well, not only for the next couple months, but I think, for, to the end of, this decade. I'm not saying you're not going to see a pullback in prices or anything like that, but, definitely I think this market is, uranium market has a lot of room to run. The supply demand imbalance is huge compared to, all the new projects that are starting up, compared to the supply of uranium that we have online. We had Cameco just didn't hit targets. Kazakhstan didn't hit their production targets and lowered targets for next year. So did Cameco. So, and we don't have a lot of new projects starting up. Again, we have, a couple in the United States and a couple in Canada. So I think those junior miners will do really well. So I would, keep your eye on the uranium market. I think that will continue to do well over the next few months. I think, oil prices here, I think we expect a sideways market for right
Okay.
now. Again, that's not a bad thing,
Okay.
barring any geopolitical issue that could come up, obviously. But that's not a bad thing. And these oil companies are still making a lot of money. I think that, this sector has really suffered. And so I think you can find some really good deals in energy companies at this point, if you obviously pick the right ones. But I think that sector is, in the equity markets, has been largely neglected, right? We kind of had a spike in after 2020 for a couple of years there, but so far this year it's obviously been the Mag 7. So I think you can find some really good deals in the energy markets right now, or in oil and gas markets for certain. And I really like copper and I really like silver right now.
Very interesting what you said before for all our viewers, what you said about the requirements of silver for the electric vehicle and the need of copper in order to achieve, at least get closer to the targets for 2030 that the governments
I
have.
mean,
Yeah,
even if we only get 1/3 of the way there, we're still going to need a lot more than we currently have. So, I don't think we're going to hit those targets by any means, to be honest with you. But again, even if we hit a third of that, then, we're certainly going to need a lot more of those metals than we currently are producing.
absolutely. I agree with you. I think that it's going to be exceedingly difficult to get to those targets in any shape or form. And that in many cases, as we have mentioned before about the UK and the Euro area, the policies are certainly working exactly against what they pretend to defend. So that's also a drag. But even so, I think that is the key point that you highlighted very well, is that it's going to be a phenomenal requirement of new mining and new investment that is going to have to come from a lot of investment also in emerging economies, no? Don't you think?
Oh, absolutely.
Yeah,
Absolutely. So,
yeah. Great. Well, I think we've gathered a tremendous amount of insight as always from you. Thank you so much, Tracy. It's been a phenomenal discussion. And what I encourage everyone is to follow you on Twitter and on social media because the information is excellent, and it's always worth keeping an eye on reality versus the narrative. So thank you very, very much for this conversation, and look forward to repeating it sooner rather than later.
Absolutely. Thank you again for having me on. It's a pleasure.
Absolutely, an absolute pleasure. See you soon, and remember all the details to follow Tracy in the details of the video below. Have a good one.
Thank you for watching this video. Please subscribe to my channel, like my videos, leave your comments below, and keep defending freedom. Thank you very much.